RBI has released directions on project finance on 19th of June 2025. So we will go through it in a very systematic manner from a banker's perspective, a learner's perspective, and from the perspective of exams. I will cover major changes and important definitions to understand the regulation in a more better way. So let's begin. Let's begin with the key highlights of this direction. This direction will be effective from 1st of October 2015. These are applicable to banks, NBFCs, urban cooperative banks, and AIFI. There are 5 AIFIs as on date, which are SIDBI, NHB, NABARD, NAFID, and Exim Bank. Now, what it says that DCCO extension capped at 3 years for infra and 2 years for non-infra. So, what is the DCCO? DCCO means when a project gets started, there is a construction phase, then a date on which commercial operation gets started, and then there is an operational phase. So, this is the date on which the construction is completed and the commercial operations started, and out of the receipt of those commercial operation, the loan repayment is done. So this particular date is clearly spelled out while funding those projects. So this particular date is known as DCCO, that is date of commencement of commercial operations. So DCCO may be extended if somehow this construction phase it is not constructed within the stipulated timeline. So in that case, the construction phase may extend, and accordingly DCCO may also require to be extended. So the capping has been there for 3 years for infra and 2 years for non-infra. What is the infra as such? What is the infra projects? So as per the harmonized master list, HML list is there, which is given by Department of Economic Affairs. There are 5 categories of infrastructure sector. Within those 5 categories, there are 37 subcategories. So what are those 5 categories? Those 5 categories are transport and logistics, energy, water and sanitation, communication, and the last category is social and commercial infrastructure. Coming to the provisioning norm, the key highlight part, that is under construction projects the provisioning requirement will be 1%, and for commercial real estate it will be 1.25%. And once the project become operational, this provisioning requirement also will come down in the range of 0.4 to 1%. And in case when there is a DCCO extension, in that case there will be gradual hike in the provisioning. So that also we will discuss whether these norms will be applicable from today or for existing project. So the effective date is 1st of October 2015. But for existing projects which have achieved the financial closure, they will be exempted from new norms. So what is the financial closure? We will discuss the definition in the later part. And then there is more principle based framework for stress resolution. So that also we will cover. So coming to the major points, projects that have already secured the financial closure before the new norm come into effect will continue to be governed by the existing asset classification and provisioning norm. These are commonly referred to as IRAC norm, income recognition and asset classification and provisioning norms, IRACP. Okay, so that you can refer from the RBI side. But with effect from 1st of October 2025, with reference to project finance, the new norms will come into effect. So what will be the provisioning requirement for under construction and operational projects? So under construction means the date till which DCCO is not achieved, the project is still being constructed. So that is a construction phase. For commercial and real estate, it's 1.25% of the outstanding loan amount. And for commercial real estate, residential housing, if the residential housing that is being built, then it will be 1%. For all other means infra projects, other infra projects, it will be 1%. What was the provisioning earlier? That also we will discuss. And once the operational phase is there, means DCCO has been achieved and the commercial operation have started, then it will drop to from 1.25 to it will drop to 1%, it will drop to 0.75%, and other infra project it will drop to 0.40%. Means in the range of 0.4 to 1% the provisioning requirement will be there. point number 2, the major highlight, it says that extension of the project. In the earlier norms for the infrastructure projects, there was an DCCO extension was allowed up to 2 years, being asset classified as standard, and further 2 years were given when there was a court case. So means total 4 years were there. In these 2 years the asset was considered as restructured, but still it was standard only, but provisioning norms were different. And for any other reason which were above beyond the control of the project owner, then 1 year was there. So from the range of 3 to 4 years it was allowed as per the previous norms. Now in this, as per the new guidelines, simply 3 years have been given. There is no such further extension based on the court cases or any other reasons. They have simply hiked it by 1 year, from 2 to 3 years. That DCCO has been permitted for infrastructure project, and for non-infrastructure project it is up to 2 years, which was earlier 1 year, and will further get extended to 1 year for the reason beyond the control of the project owner. So from 1 to 2 it is the, and from 2 to 3 this has been increased. Now what are the provisioning requirement for the deferred DCCO project? So it says for the infrastructure project it will be 0.375 and 0.5624 on non-infrastructure project for each quarter. Suppose if it's 0.375 for infrastructure project, and then the DCCO is permitted up to 3 years, then 0.375 into this is for 1 quarter. So in 3 quarters there are 3 months, there are 12 quarters, so which comes to 4.5%. But it says this is over and above the applicable standard on asset provisioning, that is 1%. So the overall provisioning for in this case will be 5.5%. Similarly for non-infrastructure CREH project, CREH residential housing, again it is 5.5 only, and for non-infrastructure project which are CRE, it will be maximum provisioning will be 5.75 at the end of 2 years, and this is in this case of infrastructure it is 3 years. So this is the provisioning requirement. As per the previous norms, this is a major change which you need to note, that earlier guidelines said that for the DCCO standard asset it was 0.40% only when there is no extension in DCCO. When there is an extension in DCCO it was 5%, but in this case we have already discussed that it's around 1% for infrastructure projects, so which is higher by 0.60%, and in this case it's 5%, but maximum provisioning as per the new norm is 5.5%. But one more point you need to note, that every quarter you need to make the provision. In the old norms till 2 years there was no requirement to make any provision, but in the new norm for each quarter on quarter you will create a new provision, so there will be higher provisioning requirement as per the new norms. So these are the important points which you may note. Now what is the principle based framework for stress regulation? It says that the reporting of credit event should be done to credit. What is the credit event? We will discuss this also. A lender shall undertake a prima facie review of the debtor account within 30 days from the date of such credit event. The conduct of the lenders during the review period, including signing of inter-creditor arrangement and the decision to implement a resolution plan where required, shall be guided by the provisions of prudential framework. So within 30 days, if there is any credit event, say one of the credit event is extension of DCCO, if extension of DCCO is there, then within 30 days there has to be inter-creditor arrangement that has to be there. So means more principle based framework that is there in this particular direction. Then resolution plan involving extension of original or extended DCO, it says that DCCO deferment as per point 2 above, which we discussed, that it will be for 3 years for infra and 2 years for non-infra project. It says that if there is a cost overrun, so cost overrun up to maximum to 10% of the project can be financed in addition to IDC. Suppose a project was earlier envisaged the cost of 70 and now it's 80. So bank may consider up to 7 crore rupees, which is 10% of it, in addition to the infrastructure development interest during construction. So if interest during construction is 1 rupee, so in this case you can, as a lender, you can fund 8 crore rupees. When there is a change in scope and size, it may be classified as standard, subject to complying with the following conditions, which are: the rise in the project cost, excluding any cost overrun, should be 25% or more of the original DCCO. Suppose it's 80 crore, now it's 100 crore, means it can be considered as a cost change in scope, and a fresh DCCO date will be there. But this should exclude any cost overrun. Say if it includes a cost overrun of 5 crore rupees, then these norms will not be applicable. It will not be considered as a change in scope and will not be given the benefit of standard classification. On re-rating, means when there is a change in scope, when re-rating is done, the new external credit rating is not below the previous external credit rating by more than 1 notch. Means say earlier it was A rated, so it may be triple B rated now. It should not go below that, means it should not be double B. Triple B will be accepted, which is just 1 notch below A. Then following conditions shall be required to be made before the expiry of 180 days from the end of review period. Means if there is a credit event, say there is a default or extension of DCCO, for a successful implementation of regional plan, these conditions are there. All required documentation, including extension of necessary agreements between a lender and debtor, creation of security charge, perfection of security, are completed in consonance with the resolution plan. The new capital structure get duly reflected in the books of lender and debtor. The resolution plan involving change in DCCO is not successfully implemented as given above, then the account shall be downgraded to NPA immediately. So this is a more principle based framework given for the resolution of stress resolution. Coming to some important other changes, that is prudential condition to related to sanction. It says that, which was not earlier in the earlier IRAC norms, it says that in under construction projects where the aggregate exposure to lender is up to 1500 crore, no individual lender shall have an exposure less than 10%. Means at least one lender should give at least 150 crore if the cost of project is 1500 crore or less than that. And for project where aggregate exposure is more than 1500 crore, then it will be 5% or 150 crore, whichever is higher. Means in that case you need to, as a banker, you need to fund at least 150 crore. That will be a minimum floor. Provided that the above minimum exposure requirement shall not apply post actual DCCO. Means once the DCCO is achieved, then this norm of 5% or 10% or 150 crore, that will not be applicable. The original or revised repayment tenure, including the moratorium period, if any, shall not exceed 85% of the economic life of project. This is also a very beautiful statement given in this direction, which was not in the earlier cases. Then there are prudential conditions related to disbursement and monitoring. It says that a lender shall ensure availability of sufficient land or right of way for all the projects before disbursement of fund, which is, in case of infrastructure, 50% right of way should be available. For non-triple P infrastructure, including CRE and CRH, it is like 75% right of way should be available. And in case of transmission line, it will be decided by the lender himself. Or TVSTD shall be required for the purpose for all the projects where aggregate exposure by all the lender is 100 crore or more. This is also one of the new stipulations which was not in earlier previous norms. A lender shall ensure that disbursal is proportionate to the stages of completion of the project, and also that the progress in equity infusion and other sources of finance agreed as per the financial closure, receipt of remaining applicable clearances, the lender's independent engineer architect shall certify the stage of completion of the project. Because there are certain stages which you need to, a project will complete it in, say this is the project implementation stages. This is stage 1, 2, 3 and 4. Like that, this stage completion will be certified by a lender's independent engineer or an architect which is deployed by the lender himself. Now, what are the various important definitions? The first thing is we have heard this word credit event. What is a credit event? It shall be deemed to have been triggered on the occurrence of any of the following, that is default with any lender, or any lender determines that there is a need for further extension of DCCO, or there is an expiry of extended DCCO, or any lender determines there is need for additional debt infusion, or the project is faced with the financial difficulty as determined in the prudential framework. So in these cases, this will result in occurrence of a credit event. Now, what is the relevance of it? Relevance of it is that the circular may be applicable from 1st of October 2015, but for existing projects which have achieved the financial closure, the circular will not be applicable. However, after 1st of October 2025, for existing project also, when there is a credit event triggered, then new norms shall be applicable. This is very important. Suppose you given DCCO extension to a particular project which was supposed to complete on 31st of July 2025, but as of now, as on date, you given extension to it, say up to 31st of December 2025. Now suppose on this date the DCCO, which is further extended DCCO, the project is not completed, then the new norms will be applicable from this date, because a credit event has triggered. Even though financial closure was achieved earlier, but the credit event has triggered for even this old project, then the new norms shall be applicable. What is the date of financial closure? It refers to the date on which the capital structure of the project, including the equity, debt, grant, accounting for minimum 90% of the total project, become legally binding on all the stakeholders. So it is also related to the concession agreement, that is an appointed date is there. So that is the concession agreement signing is there. So that is concession agreement appointed date. It is also related to concession agreement appointed date, because then only it will become legally binding. Now the most important definition, that what actually a project finance is, which was not explicitly provided in any of the earlier notification in a more detailed way. It says that refers to the method of funding a project in which revenue to be generated by the funded project serve as the primary security. Means there is no security except the revenue of the project itself. If a project is there, it is going to generate rupees 100, then the repayment will be there from rupees 100, as well as this repayment itself will stand as a primary security, because there is no other security. That's why we use earlier the word which was used to use in this type of direction was without recourse. So this is the only recourse available to the lender, that the project revenues, that's it. And also a source of repayment, and also as a source of repayment means this rupees 100 is not only primary security, this is the only source of repayment. So means this more of an without recourse type of funding. Project finance may take the form of financing construction in new capital installation, that is a greenfield, or expansion or improvement or enhancement of the existing installation, that is a brownfield project. So for the purpose of these directions, an exposure shall qualify as project finance only if the following conditions are satisfied. So these conditions are: the predominant source of repayment as envisaged at the time of financial closure, that is at least 51% repayment should be from the project cash flows, and all the lenders have common agreement with the debtor. But there is an explanation to it, that a common agreement may have a different loan terms, like some may charge a higher rate of interest, or say higher processing fees. Commercials may be different, but that may be allowed. That is up to the lender to decide. So the common agreement may have different loan term, but the lenders must have a common agreement with the debtor. That is the thing which you need to know. So I covered most of the important points of this direction related to project finance given by RBI. Hope this video will be of a great help. Thank you.